Indiacharts, the truth about the markets.
Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long-short report covering all asset classes.
Hi everyone, it's been more than a month since my last podcast. A lot of events have happened, but the market itself has remained as dull as ever. Or we may simply say there's been volatility on both sides of the equation. But the real speed, if we really remove the single group that has caused the chaos, has not been so high. We haven't seen, significant momentum moves in key large cap stocks to really help a trending move in the market. So what all has transpired so far is we've had several meetings, the Fed meetings, the RBI meeting, we've had the budget, and all of that put together has created a mixed scenario. On the one side, central banks want to continue to support liquidity. That is what is apparent from their actions, while they continue to talk tough on inflation. So we do see the US and Europe. Europe earlier was easy in its monetary policy, but with inflation crossing 10%, they have become a little tight. But as US and Europe remain tight, the others, that is Japan and China, are the ones that are providing most of the new liquidity that is coming in since January. So the US did step in a little bit of liquidity around the election time, October, November. It slowed down a bit, and then now the hand has shifted towards other nations around the world. China, of course, was shut down till December, and then they went into the reopening trade. So they have room there to actually have some expansionary policies because they need to support the domestic economy. I was just reading a post online, maybe another $95 billion equivalent of fund infusion happened on Friday. So for all of January, and I think till now, hundreds of billions of dollars, put into liquidity through the Chinese system. So when you have different central banks around the world participating, there are different ways in which we are really trying to make sense as to why the markets are going up. But don't you think this is such a prolonged discussion and debate on, people are so worried about why is the market going up. This is how at least I read the global hedge fund manager debates. They are all, apart from a few people who are tracking liquidity and sensing, okay, there can be a rebound, or maybe, the US economy is not lost ground across the board. Yes, you have hurt a certain parts of the maybe real estate sector, etc., from raising rates, but generally things have been strong, and which is why higher rates are being absorbed. Also, the corporate sector debt levels, apart from what we call as zombie companies, if you just remove that from the list, zombie companies are those that survived because of zero interest rates, which can't really pay interest on their credits, so they've just been around for the last decade, and they form around maybe around 18 to 20% of the S&P 500 companies. Now, apart from that, most companies have actually deleveraged. 2008-9, the Great Recession was a period where the banking sector deleveraged because a lot of the corporate or banking credit that went bad was either transferred or bought out. Some of the companies were bailed out, some of them were let go, and the equal amount of financing was provided through quantitative easing. So that part has already been done. Yes, when you do that, what happens is you shift debt loads from the corporate side to the government side, and so the government has taken the hold of expanding its credit and providing support to the economy, especially in the post-pandemic period. So US debt to GDP ratio in terms of the public debt, which is the government's debt, which was below 90% maybe a 10 year ago, crossed 100 and then now is at around 125%. So that is where it is. Most of the debt load is being taken by the government. In India, we can see a similar scenario. India, I've always repeated, we are around 8 to 10 years behind the US in terms of these cycles. So we go back to the late 1990s, we were at around 90% debt to GDP when the Vajpayee government was supporting growth at the end of that downturn through the 90s. And once they did that and growth picked up when interest rates actually came down in India, which is after 2001, we saw rates fall below 8%, and that triggered a boom in housing purchases, car purchases, which is going on till today. And so those low rates have spurred, the hidden middle class desire and demand to own homes and cars, which has been part of the large, single purchases apart from general consumer spending. Now, as all that happened and corporate debts expanded because they were, going into infrastructure, power, building, all that, we ended up with our own debt crisis problems which showed up after 2015. They, of course, were part of the pre-2008 boom phase. And so that all got bailed out 2018, 19, 20. And then post-pandemic, the Indian government had to step in, spend more money. And doing that, our debt to GDP ratio, which had come down from maybe 90% to 66% or 64% at the lows, is back to closer to 90% because of all these gaps in between. But the good news is our tax receipts, unlike the US, are much more buoyant and resilient, because and every time there's inflation, there's some growth that is happening, 7% plus or minus GDP real growth is helping tax revenues remain pretty strong. GST revenues have grown year after year after year. The US remains on a tight limb on that. A slight slowdown in the economic activity out there results in lower tax receipts, making their own deficit problem bigger. So we all face different levels of problems, because like I said, we are behind them in terms of the curve in the economic cycle, and they're ahead in terms of where they have troubles. But one thing that has happened in both nations is that corporate level credit problems have been brought down, at least in India. So it's come down because a lot of the bad debt got transferred, corporates cleaned up. Metal sector, which was high on credit because of the commodity boom of 21-22, have reduced their debt levels. And so in general, we can say India's corporate sector is low on leverage. The only recent leverage issue we've heard so much about has been around the Adani group, and apart from high valuations, that's been so it's a twofold issue, right? One is high valuation, one is high credit. Now that's also brought down to some extent. Various banks have cleared their positions of not being overexposed, and so the credit is spread out, and so there's no single bank that would end up taking the burden of excessive credit. And of course the issue remains open in terms of whether anything what should we really say, did anything happen which is not normal in terms of business, which means was there any bad doings on their part. That's the only thing which should create risk. Otherwise it is a business risk, right? You invest in infrastructure, there's a 5-6 year kind of cycle before which you can actually start repaying loans, and so there are timelines, and you have to invest in certain projects and complete them over a certain period so that the credit remains good and you're able to repay. I mean, that's how it has always worked. And if that all is true, if there's no other scam or anything involved, then that's how it's going to be. And there's no overexposure in any particular bank. The only issue would remain, valuations were high. They've taken a knock. We can debate whether they are high yet or not. The good thing is, from a pure market analysis standpoint, is that all of this bad news has come and passed. Of course, it is having an overhang yet on the market, which is probably why after the budget day, when a lot of the announcements happened, we haven't really had a runaway move. I would have thought you would, but the overhang has not let it happen. Even today, Adani Enterprises was down around 6%. So that's probably caused banking stocks to weaken a bit. So this news flow is continuously going back and forth on this issue, and that is probably causing the near-term volatility. And we can only hope that it's behind us sooner than later. At the same time, while we are trying to discount this issue, and remember, we've made a low point, the budget day highs and lows are sentimentally important pivot levels, and so 17,353 is an important pivot from where I would think for months probably the market would remain above that level, and it could be very, very positive because we made a low point after a 2-month decline from December through January. The only thing is we haven't bounced from there sharply. So will we get a sharp bounce? Will we start shifting away from looking at the problems of a single group to the rest of the market, the economy, and the positive effects of what the budget has really laid out? And also the case that, global liquidity expanding causes some resilience in terms of growth, which is already there. And we start pricing that into our own models and factors, because businesses, started to pull back. It started to show in slowing numbers. For example, the IT sector. But moment everyone feels a little easy that things are not going to get as tight as we thought, maybe there's a case for a soft landing, then business starts to flow and earnings do start to revive. So that is the hope that we are living at. The debate between hedge funds remains whether you can or can't get a soft landing, because debt problems are still high. We have caused a slowdown in housing. There's still wage inflation. Will it squeeze profits or not? But when you get, percolated inflation, which is that where it actually spreads through the entire system, then it's really not only about commodity prices. It's really about prices of everything going up. This is an argument you would have heard me make maybe a year ago or year and a half ago, when I was still bullish on the market irrespective. The idea was that, inflation can remain elevated. If it remains at the same level after a 6-month or 12-month period, the base effect causes it to come back to zero. That's the phase we are in right now. We've seen peak inflation. We are seeing it come off. Base effects will kick in over the next 6 months. Unless there's a new inflationary cycle, numbers are not going to run away. But if prices of some things go up, everything goes up. So you don't just see CPI, you see PPI, you see wage inflation. So when price of everything goes up, then essentially you're not seeing a slowing down of demand. You're seeing a repricing of the economy, which is sort of what was the whole MMT theory, right? Modern monetary policy really wanted to push up the debt to the GDP level so that the debt to GDP comes down through inflation rather than through deflation. As that's the fight, then we are fighting a fair fight in terms of going back and forth. Create a little bit of inflation, then take a few steps back, let it cool off. Don't let it overheat. The overheating is essentially been the result of what we ended up doing in the post-pandemic period, which is overspending. Trillions of dollars of stimulus, low interest rates, and freebies to everybody, at least in the US and India. We were far more cautious about giving out freebies. I think we did some things where we thought were necessary. We actually kept things tight. So there's been some liquidity injection, which the RBI is still saying they're going to remove, but actually not been too much. So India shouldn't have really had persistent inflation. But then part of the reason is that it's global. So when prices everywhere are going up, it does have a sentimental impact and rub off on your own market as well. And that may be the reason why inflation in India also is at a slightly higher level. But there's this other thing why inflation will remain high. There are many arguments. Mine is very simple. It's the commodity cycle. But the commodity cycle per se cannot be reason for inflation. See, inflation is something which is more deep rooted. It's about prices of everything going up. If just certain costs go up, does it cause inflation? So you go back to 2002 to 2008 bull market. Oil prices went from $30 to $140. Did it cause inflation? Only at the fag end. I mean, we remained between that 4-5% inflation range for most of the time period. At that point where oil went to 140, yes, we saw a spike in inflation and raised rates. But by that time, we were already in the next bear market because of the US housing bubble. So there's this interim phase where you can actually, walk on a thin line, have some balance. It can last for a year or two, if not more. And that can be a boom phase. So are we really entering a boom phase because of low interest rates and a falling dollar? That's the theory that I'm really trying to push at. The dollar peaked in September of this year. Initially, I waited for a long time till January to see will it go back below the breakout point of 104. Now it has gone below that. It's struggling to try and come out. Maybe if it does come also temporarily, we'll have to seriously think about whether it's temporary or not. Because if the larger trend of the dollar was up, why did it take such a big hit? Clearly, we don't want a strong dollar environment. It doesn't help anybody. And a weak dollar environment does push up commodity prices, but it's very helpful to emerging markets and growth in general. If you can simply keep the dollar from going up too much and keep it even flat, it's good for everyone. There's no currency volatility. People who are net borrowers in dollars, their pressure eases, liquidity improves. And last but not the least, can certain countries then actually bring down interest rates? Because if you don't have an inflation problem, if the dollar is stable, if inflation gets base effects, then places like India where the yields had shot up to 7.5 and I was actually scared if it breaks out of that, we'll go to 9. Again, for a second time, anticipating that goes wrong, it can end up being a good thing. 2018-19, I was anticipating that spike above 8%. It didn't happen. We did go to 8.1 or 2 and then fell off. And so it was a temporary reaction in the markets, but after that things stabilized. So once again, we've come to 7.4, 7.5. We've topped here 3 times, I think, in the last couple of several months. If we don't break out beyond that and bond yields start to go down again, then we have a case for falling interest rates. And once we start seeing that, I think markets will become a little more cheerful than they are right now, because suddenly high valuations don't become the problem. When you get interest rates going down, suddenly valuation models allow for some higher prices, and therefore that's one sort of support that you end up getting. Now, of course, the earnings growth in the last 1.5 year that we have seen has helped bring down the PE ratio. But part of the PE ratio decline that you see in the PE charts at the start of 2021 was really because we changed the methodology in which we calculate PE. Earlier, it was based on standalone earnings of companies, and now it's based on consolidated. Now, consolidated is definitely a better way to do it, because a lot of companies have ended up building subsidiaries, different businesses, some are hiving off companies, and the total revenue really counts. I mean, take the example of even the biggest company like Reliance. It has a geo and a retail, and you actually want to look at the overall PE and valuation of the company and not just the holding company itself. And so with that model becoming common, So many companies have, subsidiaries whose revenues need to be counted. It's good we moved to consolidated, but that led to around a 6-point drop, I think, if I'm not wrong, 6 or 8-point drop in the PE ratio. And then after that, so it had PE ratio was appearing absurdly high at close to 38, 40, and that came back to 29. And then actually earnings growth kicked in because of the stimulus in the post-pandemic era, which caused earnings to grow, which kept growing till, mid of 2022. And that earnings growth of 15-20% brought the PE ratio further down to around 20 where it is right now. So it's equitable with what we were seeing pre-pandemic, but actually the ratio may be a little higher if you actually take standalone. So but even then we are on a consolidated basis back to the levels that we were on a standalone basis pre-pandemic, which is still a good low reading. The only thing, it needs to be justified by lower interest rates. Otherwise, we can keep having the argument saying that no, it's not overvalued, it's not undervalued, but it's fairly valued, which is sort of what most of the fund managers you will hear on television saying. And then the approach becomes to find the right companies. Let's forget about, whether it's undervalued, overvalued. Let's buy where there is value and where there's growth, because if there's growth, then there's value. So you end up giving a premium to growth or individual stocks where mid and small caps start doing better than large caps. So that's one theme to really think about, because if the market stabilizes, you get lower rates, you get a falling dollar. One of the places where you can get a boom, which has been pretty dull in the last 6 months, is going to be the mid and small cap stocks, where emerging stories are really taking place. So that's, I think, where the big, baggers will really happen in terms of the stock market. In the large caps, you can only look at sectors. Like, for example, you can think of, well, the government is spending on capital goods. Last year, they're spending even more this year. So the capital goods sector ends up doing well. You get a falling dollar, you can get a commodity cycle. Then the cyclicals and commodity related sectors can actually do well. And then if global growth stabilizes, the IT sector can make a comeback. So these are easy themes to really think about. But otherwise, you'll have to actually go bottom up and look for individual stocks which are building in certain businesses, certain areas, and showing exponential growth, whether it's on the make in India story related stories, or whether it's something related to the electrification, green energy, or anything which is ESG related. Those could be different themes that will pop up from time to time. And then there's value stocks, which are the PSU stocks that really picked up last year. Anytime economy grows, the PSU stocks which are across sectors actually end up doing pretty well. So many themes to really think about and pick the best within them. And one of the ways is simply to see where is the relative strength, which are the companies that are holding out better than the market, and chase performance. So you can actually be a performance investor, different approaches for different people. But the overall point being that a lot of the negatives have played out. They're getting priced into the market. The market's upward momentum may have slowed. Sure, it could have fallen a lot more and it didn't. But that it didn't is itself sign that probably we are done as far as things are concerned. Now, when we look at positioning, that further helps that, because at 2 or 3 of the recent bottoms, we've seen extreme shorts built up. It had not happened at the beginning of Jan when I was actually reading into the put call ratios, but post this Adani crisis, significant shorts have been built up in the futures market with FIs and overall positioning. If we look at, adding up all the calls and puts, I was being told by my analyst that by Jay essentially that the total amount, if you add it all up, is actually now higher than what it's been over the last couple of years, maybe surpassed the pandemic reading. If you add up, net positioning across futures and options on a quantity basis, which is number of contracts. So that's pretty interesting. Things are getting that negative. If the sentiment is getting that negative, then it can't really fall. The only thing is that you fall because, today even Adani stocks were down and it was a holiday and there's no US trading, and so there was nothing to move the market. But actually, if I look at volumes for today, which is the 20th of Feb, volumes are very, very thin. So the fall was on very thin volume. So I would actually be suspect of such a decline. And we've closed right at the 20-day average, which is around 17,838. So we'll see tomorrow as you watch whether these levels hold. If they do, we should see the resumption of the rally. That is what I would think short term. But in the big picture of things, I think there's a medium to longer term bull case, which is now possible because of how we've discounted a lot of this negative news that has flown in. And of course, we have a budget which is supportive of growth. And all we need now last is monetary policy kicking in, where we can actually move towards lower rates. It may not happen immediately, but bond yields can be ahead of the curve before even RBI moves on rates. you might actually start seeing bond yields cool off, and that's the thing to really watch. If they fall below 7.2% on the 10-year GSEC, I think we should be out of the woods as far as the bond yield trend is concerned. And so that's the other big thing to really watch out for. We have very similar readings in the US as well. The US S&P futures, speculative contracts reported by the CFTC in the COT report is actually showing 209,000 contracts short. And it's been something like this between 200,000 to 250,000 up and down for several months now, I think all the way back from August, September. In that period, the markets, had several bounce backs, and each time it's not been able to break below that, the lows. It's made a new low, but again rallied back harder and harder because of this short position squeezing. Now, of course, we can see shorts remain short throughout bear markets. But at the same time, if something changes and the perception of the market changes, then you actually end up seeing covering before you get another leg down. And that's what we need to watch out for. Either the soft hard landing thesis playing out, or else the shorts are squeezed and forced to get out of those trades as the hard landing case becomes less of a potential outcome. So that's, I think, the judgment call they will make. But right now, the short positioning is definitely helping in keeping markets elevated, and can even push us into a further rally for US equities. So this is the overall setup for markets. These are the things to watch out for. Even though this is the third month going, but we might actually, let's see, we have a week left, 10 days in terms of trade, rather 8 days, I would say, 20, 27, 28 of this month, we'll have the monthly close. If we can actually close positively, that would be a good sign. We've had 2 down months, December and January. It looks like to me that the worst is over, and we will look at whether that actually plays out in the coming days. Thank you.
Nothing in this podcast is investment advice. Views on financial markets are in good faith to expand your understanding of how markets work. Please consult a registered financial advisor for the same.
And yes, please share this podcast with everyone you think can benefit from this knowledge.